All right, let's dive into the world of global accounting standards. Now, I know what you might be thinking. Accounting standards sounds a little dry, right? But stick with me, because we're about to unpack the very first and honestly the most critical step of IFRS 15. This is the rule book that tells companies all over the world how to book their revenue. And to see why it matters so much, we're going to start with a really simple, everyday purchase. So let's start with a question. Picture this. You're a company, and you sell a customer a brand new smartphone. But they don't just walk out with the phone. They also sign up for a 2-year service contract with you. So the big question is, when do you actually get to count that money as revenue? Is it all at once, the moment they sign? Or do you spread it out, bit by bit, over those 2 years? You know, this seemingly simple question is actually a huge puzzle for businesses everywhere. And how you answer it has massive implications for a company's financial health, its stock price, and really the trust that investors have in it. Luckily, the answer is governed by a pretty powerful global standard. And that standard is IFRS 15. It gives us a single 5-step framework that companies have to follow. Today, though, we're zeroing in on the absolute bedrock of that entire model. Step 1, identifying the contract. Seriously, if you get this step wrong, the whole structure just falls apart. So what even is a contract in the eyes of IFRS 15? That's what step 1 is all about. Before a company can even dream of recognizing a single dollar of revenue, it first has to prove that a valid contract with a customer actually exists. The standard itself gives us a pretty formal definition. A contract is an agreement between 2 or more parties that creates enforceable rights and obligations. Sounds straightforward enough, right? But here's the catch. For accounting purposes, that formal definition is just the starting line. An agreement has to pass a really strict set of tests to be considered legit. You know, a quick email exchange or a verbal promise might feel like an agreement to you and me. But IFRS 15 sets the bar much, much higher. It lays out a very specific checklist, and an agreement has to meet all the criteria on it to qualify as a contract for recognizing revenue. And that brings us right to the core of step 1, the 5-point contract checklist. I want you to think of this as a series of gates. An agreement has to pass through every single one of these gates before it can move forward. So here they are, the 5 tests. First, the contract has to be approved. Then the rights and payment terms need to be clearly identified. It also needs to have a real financial impact, what we call commercial substance. And finally, and this is a big one, the company has to be pretty sure it's actually going to get paid. Okay, let's break each of these down. The first gate is approval and commitment. This might seem like a no-brainer, but it's absolutely crucial. Both sides have to be locked in. That could be with a signature, an online click, or even just through established business practice. A casual chat just won't cut it. Both parties have to be genuinely obligated to follow through on their promises. Next up, the terms have to be crystal clear. There can be zero ambiguity about what each party gets, like a specific phone model or a certain amount of data, or what the exact payment terms are, say $50 a month for 24 months. IFRS 15 leaves absolutely no room for guesswork here. Now this fourth one, commercial substance. I know it sounds like a bunch of jargon, but it's actually a really powerful anti-fraud tool. It's asking a simple question. Does this deal actually matter to the business's bottom line? The contract has to genuinely change the company's future cash flows in some way. This is what stops companies from booking revenue on sham deals, like just swapping assets with another company to make it look like a sale happened. And finally, we get to the ultimate reality check, collectability. I mean, a contract is pretty meaningless if you don't actually expect to get paid, right? The standard says collection must be probable. So if a company sells something to a customer knowing they're very unlikely to ever pay up, they can't book that as revenue. There has to be a real, honest expectation of cash coming in the door. So what happens after you run through the checklist? Well, it's a simple fork in the road. If an agreement passes all 5 tests, then great. You have a valid contract under IFRS 15, and you can move on to the next 4 steps. But if it fails even one of those tests, the brakes get slammed on. Everything stops. Revenue recognition is put on hold until those issues are fixed. Okay, but you know, the real world gets a little messy. What happens when a customer signs a bunch of different agreements at or around the same time? Is that one big deal, or is it a bunch of separate little ones? Well, IFRS 15 sees this coming. It gives us clear rules, kind of like the logic you see in this flowchart, for when you need to combine contracts and treat them as a single package. For example, if they were all negotiated together, or if the price of one depends on the other, you have to bundle them. Ultimately, it all boils down to this one key question. Were these separate documents all part of a single business deal? Do they share one commercial objective? If that phone and the service plan were negotiated as a package deal, you treat them as one single contract, even if they're on separate pieces of paper. So let's bring it all together. Why have we spent all this time focusing on just the very first step? Because getting step one right isn't just important, it's absolutely fundamental for reliable financial reporting. To really get a sense of the scale here, think about the combined annual revenue of just a few of the world's biggest tech companies. We're talking well over $1 trillion. Every single dollar of that staggering amount, from every app download, every cloud subscription, every online purchase, it all has to pass through the gate of step one. Getting this foundation right ensures that everything built on top of it is sound. It leads to accurate financial statements that people can actually trust. It builds investor confidence because they know the revenue being reported is real and accounted for correctly. It's the solid, non-negotiable starting point for all revenue reporting. So whether you're an investor, an employee, or a business owner, it's worth asking yourself, how solid is that foundation? How robust are the contracts that all the revenue you rely on is built on? Because as IFRS 15 makes crystal clear, without a valid contract, there is no revenue.